Hello and welcome to this Tolley Seminars Online lecture where I'm going to be taking a look at the changes announced in the Chancellor's budget last week affecting employees and employers. My name is Chris Jones, Director of Tax Markets and Learning Solutions at Tolley. Now, the first change I'd like to look at is a small announcement which can mean a great deal, and that is the increase by 4.5% or £900 in real terms in respect of the car fuel scale charge multiplier, taking the level now to £21,100 effective from the 6th of April 2013. And what I've done is to calculate, just taking a bog standard family car provided as a company car with an overdrive or fuel card attached to it, whether it is actually worth having a fuel card. So I've chosen the Ford Mondeo 2-litre diesel Zetec, and I'm assuming that the individual is able to get around about 40 miles per gallon from the car, or that works out to be 8.8 miles per litre. Now let's look at the tax liability applicable to the fuel benefit. Now the multiplier, of course, is applied to the P11D percentage applying to the car. So this particular Ford Mondeo attracts a 19% benefit in kind in respect of the percentage we apply to the list price to work out the car benefit. So that then gives us £4,009 when you multiply the 19% with the fuel scale multiplier, £4,009 added to your income. You're then taxable on that at 40% if you're a higher rate taxpayer, meaning that your tax liability is around £1,600, and £800 if you happen to be a basic rate taxpayer. So what I've done in the last part of this slide is to look at what the break-even mileage would be, assuming that the average cost of diesel is £1.45 per litre. So for your higher rate taxpayer, that would buy you 1,106 litres, which would then enable you to drive 9,734 miles, or for a basic rate taxpayer, that's only 4,867 miles. So the break-even miles tells you how many private miles, not business miles, but private miles you need to drive in order for you to ensure that you're getting at least the same amount of benefit from the pump as you're paying in tax. If your private miles are below those limits, you'll be better off unilaterally handing your fuel card back to your employer and saying, I don't want this anymore, because you're actually paying more in tax than you're getting in benefit from the pump. If, however, you can talk your employer into giving you, say, another £1,000 or £2,000 on your salary instead, then you are much, much better off in those circumstances, because, of course, at least with extra salary, you pay tax on what you receive, rather than with a fuel card, you pay tax on a spurious figure based on £21,100 multiplied by the P11D percentage that obviously relates to the CO2 emissions of your car. So some food for thought there for some additional planning. And remember that with the fuel scale charge, that once you've actually been given by your employer just one private mile in a tax year, then it applies to the whole year. So you're better off looking at this perhaps before the new tax year begins on the 6th of April. Let's look at two new provisions that the Chancellor has introduced in this year's budget, which we were not aware of before. The Chancellor made big bones on the announcement here on the employment allowance, which is going to be worth £2,000 to all employers from April 2014. Basically, all employers will receive a credit of £2,000 against their cost of employment, i.e. their national insurance, which will be delivered through the RTI system. And it replaces the failed regional employers NIC holiday scheme, which attracted less than 14,000 employers claiming it. So this is a blanket £2,000 off, which will apply to every employer in the land. The Chancellor has also introduced employment-related loans exemption to be doubled to £10,000 from 6th of April 2014, which is obviously going to be very helpful for employers who make season ticket loans, because of course the cost of season tickets is going up all the time, and many people now are having to have loans from their employers above £5,000, which obviously brings those loans into scope for income tax. That will be exempt from 6th of April 2014. But in addition, thinking of your OMB client, where the individual has borrowed more than £5,000 from the company, you will have the burden of completing P11Ds and working out beneficial loan calculations for those companies. From 6th of April 2014, with the limit going up to £10,000, you'll find that a number of those OMB companies and their directors will be out of the P11D regime, which is good to know. Now, the Chancellor has also made some further changes to the owner-employee shares. Now, the plans are for a new kind of employment contract called an employee-owner contract to be introduced to enable employees to exchange some of their employment rights for rights of ownership in the form of shares in their employing company. Now, the minimum amount of shares that must be awarded free of charge to the employee must be £2,000, but no more than £50,000 of shares can be exempted from the overall CGT charge. So the minimum payment you can receive for your employer will be £2,000. There'll be a cap of £50,000 in respect of CGT exempt shares. But the other thing that's pleasing to know, which will be included in this year's finance bill, is that the first £2,000 worth of shares that your employer gives you in return for your employment rights will in fact be free of income tax and national insurance. But if you're given more than that, then the excess will be liable to tax NI, obviously in the normal way. Now, there is something quite sinister about these rules, and therefore something that needs to be drawn to your attention. The rights that the employee will be giving away under the Employment Rights Act of 1996 will relate to things that the employee might actually quite value. For example, they'll be given less rights for study and training. They'll be given less rights for asking for flexible working arrangements, particularly if they're having to fit work around family commitments or looking after their children. But more importantly, you'll actually be receiving less or have less rights to redundancy payment, if no rights at all, and very limited protection for unfair dismissal. So, for example, your employer says, I'll give you £2,000 worth of free shares in return for a new employment contract. 2 months later, make you redundant with no payment whatsoever, whereas you could be due, a good chunk of money for being made redundant. Something quite sinister there, and therefore any employee who's offered these new contracts, I would suggest they seek advice from an employment lawyer to see what the downside might be. Now, very interestingly, on the evening of the budget of the 20th of March, the House of Lords actually turned down and has stalled the Growth and Infrastructure Bill, which actually includes the provisions that cap these employment rights in return for these shares. So where this provision currently stands is yet to be known. The government, of course, is currently looking into whether they're going to push this bill through under the Parliamentary Act. So stay tuned. Enterprise management incentives. Now, the Charter has introduced some changes here, whereby the 5% rule, whereby you need to have at least rights over 5% of the shares in the company, will be disapplied for options granted on or after the 6th of April 2012, where the shares are sold on or after the 6th of April 2013. The period over which the option is held continues to qualify for the 12-month holding period is unchanged, so therefore you can actually essentially get risk-free enterprise management incentive rules in the fact that you are granted the option, and then when you come to exercise it, as long as the option and the exercise are at least a year apart, you've actually met the conditions for the entrepreneur's relief. Now, the disposal will be extended to cover shares exchanged as part of a reorganisation, whereas previously those rules did not permit that. So that's another change to the EMI rules, making them perhaps more applicable in certain circumstances. The Chancellor is looking in the autumn of 2015 to introduce a tax-free childcare scheme. The basic tax rate tax relief will be £6,000 of eligible childcare costs per annum, so worth £1,200 to a 20% taxpayer. And it looks like these rules will be applicable to both basic and higher rate taxpayers, but not additional rate taxpayers, because neither parent can earn over £150,000 in order to claim the £6,000 worth of eligible childcare costs. There is also another condition whereby both parents need to be working and cannot be in receipt of tax credits or the universal credit. So we'll see how these provisions are fleshed out in the coming months and years before their final introduction in 2015. The Chancellor has also taken the opportunity in this year's budget to look at the RTI penalty regime, and it's previously confirmed in the autumn statement, there will be no late filing penalties under RTI for both tax years 2012-13 and now 2013-14. The existing penalty regime will apply if there are late returns at the year end, which will be £100 per 100 employees or part thereof per month that you're late. So it obviously can rack up for large employers who are very late. Now, late filing penalties applicable from April 2014 will apply. The first month in the tax year which you filed late will not be subject to a penalty, but thereafter penalties will be triggered. The penalty is triggered if the full payment submission is not made on or before the time of payment to the employee. But for employers with multiple paydays in a month, the legislation will only actually trigger one per month. Obviously, otherwise the rules would be unfair in respect of employers who are paying their employees more regularly than monthly. Now, a fairer regime will apply from next year in respect of in-year PAYE penalties to work much more like the VAT default surcharge. Currently, the rules are quite draconian in the fact that you count up the number of times that you're late, you deduct the first one, which you're allowed free of charge, in inverted commas, and then all the penalties apply at that particular level. So, for example, if you're 10 or more times late, then basically you will actually have a penalty applicable at 4% on every time you're late. Whereas into next year, the penalties will work that much more smoothly, in the fact that the first, second and third defaults after your first one will only be liable at 1%, the next three at 2%, the next three at 3%, then after that at 4%. So you'll actually be paying penalties at 1, 2, 3 and 4, rather than the current regime, they're all at 4 if you are 10 or more times late. So that is obviously going to be a better regime, but that doesn't apply for another year from now. The Chancellor is also consulting on a number of items relating to national insurance and employment taxation. Firstly, looking at collecting Class 2 national insurance, not through direct debit, but through self-assessment. He's also looking at increasing debts collectible via the PAYE notice of coding, subject to further consultation. A £500 tax-free benefit in kind for employers paying for health interventions to enable sick employees to return to work. Currently, if the employer pays for, say, additional occupational health, even if that's recommended by health experts, that's a taxable benefit in kind potentially. There'll be a £500 tax-free limit going forward. Self-certification for advantaged employee share schemes has been recommended by the OTS, but it's not clear where the OTS recommendation on unapproved share schemes will be picked up. A new CGT relief for disposal of controlling interest into an employee ownership structure, but that sounds very exciting, was announced in the Chancellor's speech, now enabling owners of companies to leave their company in the safe hands of their employees. Big problem with that one is that they must actually leave a controlling interest, which in my mind could significantly reduce the attractiveness of this scheme, because many individuals who own their own company might want to pass out some of the company, but not a controlling interest. And the Chancellor is also going to be consulting on improvements to the payroll giving regime. Well, I hope this is a very useful roundup of the core provisions introduced to affect employment taxation in Budget 2013. My name is Chris Jones, Director of Tax Markets and Learning Solutions at Tolley.